Good afternoon, everyone. We're just about to start. We've got a couple more people logging in. It's just gone 3 o'clock. Thank you for joining us. My name's Craig West and I'll be hosting today's session. I'm going to run through some of the key issues and learnings around employee share ownership plans. So let's get started. There are a few more people, as I said, to come through, but we'll get started anyway in view of time. As I said, we're going to be talking today about employee share ownership plans and specifically how to attract, retain and motivate key employees within your business using employee share ownership plans and some of the methodology that we use behind employee share ownership plans to design them, introduce them and to make them more effective in terms of how they work within a business. It's all about, for us, business succession and exit planning. Obviously, that's what we do. We're focused on helping business owners, particularly mid-market business owners, prepare their business, maximise value, and ultimately achieve a successful exit. I'm often asked what succession's all about, and I think it's really about getting three things right at the same time. Firstly, the business needs to be ready for an exit, or succession, or sale, or employee share plan. Doesn't matter what your exit strategy or exit option is, the business needs to be ready. The financials need to be ready, not just the business financials, but also your personal and other shareholders' family financials need to be ready and organised. And personally, as an individual, you need to be organised and ready to exit. And that might mean thinking about what you do post-exit, in retirement. Obviously, we've already talked about the financial aspects, but the non-financial just as importantly. What are you actually going to be doing after retirement? Getting those three things right all at the same time does take some work and preparation to make sure that actually happens. The way that we do that is we run through a 21-step process. It's a model that we've been using for nearly 10 years now, and it works very well with clients. You'll see there's 5 different stages, all focused around value. And we work through this process with our clients to make sure that each of these things are ready to go and that they are well prepared for an exit. In terms of employee share plans specifically, there's a lot of interest in this topic at the moment. In fact, right now in Australia, there are 2 separate Senate inquiries running on employee share plans, one on using them to improve productivity and the other one on taxation of employee share plans and whether that could be more effective as well. It's a very, very hot topic at the moment and has been becoming more and more popular since the government changed the tax rules back in 2015. But it's certainly an area now where I think business owners are starting to see sustainability benefits, innovation benefits, and certainly locking in and rewarding key people in the business. Interesting, this quote is the former chair of the John Lewis Partnership, which is a massive employee share owned business in the United Kingdom, about 81,000 employees, and they all own shares in the company. And it's interesting that he's talking about the result of an employee owned business is competitive advantage and lasting success in both good times and bad. So interesting scenario. The big issue at the moment, of course, is employee retention, where we've got, particularly in professional services businesses, where those businesses like mine are heavily reliant on key people. The cost to change those people over, to replace them, retrain them, upskill them, lost productivity, etc. It's estimated at about 45% of an annual salary. So if you've got an accountant or a lawyer or a financial advisor or an architect on $100,000, then that's going to cost you about $45,000 to replace that person. And that's not an expense that most businesses want or need in the current environment. So it's really about making sure that when we've got to get good people, but when we do get them, that we lock them in and reward them according to performance. And we'll talk about some of the different ways that we work on doing that shortly. I'm going to run through 3 key things today. Firstly, a ladder to equity model, which is a remuneration model that we use with our clients to design and structure remuneration for employees. Ownership mindset, which is a management school of thought and training system, I guess, for employees to understand better how the business works and how their involvement and role within the business can improve performance. And then we're going to look at some of the technical aspects of the employee share plans themselves and how they might actually work in businesses. Let's start with the ladder to equity and have a chat about what that actually means. It's a great quote from Warren Buffett: employees are keen to climb the ladder to equity, but someone needs to provide the ladder. And I think that's true in most businesses, certainly true of the new generation of employees that are coming through now. They've been around during this age of entrepreneurship and innovation and startups and capital raisings, and they're seeing some of the, the FANG stocks in the United States hitting record highs. Just the other day, Apple hit a record high. It's becoming quite common for people to understand and see how equity ownership in a business can lead to that kind of performance. Let's go through the ladder step by step. Step one is just an employee earning income. Now, there's nothing wrong with that model. It's been around for many hundreds of years and it works. But my view is it's not enough, and it doesn't work well enough to stop at that step in the ladder. Most employees do stop at that step. They work for a business, they get paid an hourly rate or a salary, a fixed salary. It's, to put it very cynically, it's about turning up and getting paid, but it doesn't do anything more than that. There is not much attachment at all between performance and reward. It's just a fixed payment for being there or for turning up. And it does create some issues, and it certainly doesn't encourage or foster the employee ownership type model that we're talking about. The first step up the ladder and the first improvement on that simple income model is to enhance the income with some kind of bonus or commission or incentive payment. Typically, and most commonly, that's a sales commission. So certainly in real estate businesses, for example, most real estate agents are paid a very low retainer, but a very high commission on sales that they achieve, which means that they've got to perform to actually earn reasonable sorts of money. And so that step is a good one. It works. It can improve performance and certainly focuses people with an incentive type payment based on performance. But it's got a couple of issues. The first one is it's entirely individually focused. So there is no element of team-based behaviour here. The second one, and that can create, you often have seen or worked with people, I'm sure, where behaviours that are really generated or governed by the way that people are paid are not necessarily in the best interests of the business. Most commonly, I know, certainly I've seen and worked with salespeople who've either held orders back. Today's the 25th of June, and therefore I'm going to hold the order back till July because there's no way I'm going to meet my target in June, so I might as well keep it, and hopefully that'll help me get up to my target in July. I've seen others that have bought orders forward. It's just not behaviour that works well in terms of the business concept. It's there because that's the way that employees get paid. And I think it's important to understand that the way that you pay your employees does have a very, very direct effect on the way that they behave. The next step in the ladder to equity then, to improve that somewhat, is to go to a profit share model. And the profit share model, this is really the first step towards some kind of equity plan. And in fact, we often use profit share plans to fund equity into our employee share plans. Two key benefits here, as opposed to the last sort of income incentive model. Firstly, we're talking about profit. And profit is not just income or revenue, it's also expenses by definition. And so now we start to get employees thinking about and taking notice of our expenses within our business. What can they do and how can they work with us to improve the overall profitability of the business? The other thing is, generally in most businesses, you can't achieve profit on your own. It's a team-based approach. And so we start to get employee behaviour aligning with other employees and finding that it's much better to work together as a team to generate profits overall than as an individual. And that's not a bad thing. That's a good spot. We have got some clients who've stopped at this step on the ladder. For whatever reason, they haven't gone on to an employee share plan, and that's perfectly fine. The profit share models certainly can work, and they do work quite well. The next one then moves along to what we call an equity plan or an employee. This is actually an employee share plan, if you like. It doesn't have to be an employee share plan, but often equity plans are based around employee shares because that gives you the mechanism and the structure to manage how that works. It allows employees to actually own equity in the business that they work for. And that's a very substantial difference to the previous three steps in the ladder. This is now about capital gain and appreciation of the underlying asset. The previous models were all about income. There's no ownership and no equity, and therefore no capital gain or access to the growth in value of the underlying business asset, which is what this particular stage does. And that's quite an important step for most employees. It's quite different to their normal income-based models, and it does, if you like, align them far more closely with the owners of the business over time. Last step in the ladder then, and again, some clients don't need to go to this stage, but often, and nearly always, in fact, at some point, the business owner will want to leave the business and somebody needs to manage and control the business at that point. My recommendation with our clients is that this is a gradual handover towards control, not I'm leaving on the 30th of June, see you later, good luck. It's a gradual managed process to educate, involve, and then gradually hand over elements of control within a structured framework to those people that are taking over the business when we decide to retire or sell or move on, etc. As I said, 5 steps in the ladder, sequential. My recommendation is they're done in order, and you gradually move from income into the commission or incentive bonus income, into some kind of profit share plan, ultimately up to an equity plan, and then officially, there's a handover of control at some point. We've used that model with many clients. It's always worked well. Clients some of them stop at step 2 or 3, others move right through to steps 4 and 5. But either way, it's a great model to understand. And the important thing to model and make sure you get right is that the employee's behaviour is directly impacted by the way that you remunerate them. So if you can tweak and improve that remuneration model, you will get better employee behaviour. And obviously one of the key pretexts around the employee share ownership plan is that we're aligning owners' interests with employees' interests, and we should therefore be able to align the behaviour as well and get much better outcomes for everybody involved. Let's talk about ownership mindset, which is actually the management model that we use. We teach our clients and their employees what this is about and how it works, so that there's a much better understanding of the business and how it operates and how it makes money. And I think the key thing here is that this is about involving employees in driving the performance of the business. It's about educating them, helping them understand what it is that they need to do and how they can best contribute. And ultimately, we want to get them to think and act like business owners. If we can get 3, 4, 10, 20 people in your business to think and act the same way or a similar way as what you do as the owner, you will get dramatically improved performance without any doubt. Let's have a look at the model itself. It's basically looking at 4 key stages from the top down: the right people, putting them in the right place, knowing what they're doing, understanding what it is that they know, surveying them. The right knowledge, so education. Now, this is not education. If this is a financial planning business, this is not education about how to be a better financial planner or the technical aspects of tax or superannuation. This is about the business of financial planning. How do we run the business? How does the financial planning practice actually make money? And you'd be surprised, even in some quite seriously well-qualified professional firms, how little employees understand about how the business actually works and makes money. The next one then is systems, and systems in a key focus really on KPIs and measurement and reporting of dashboards, forecasting using the KPIs, and actually focusing on what we're measuring. Not just measuring everything we can, but focusing on the important things to measure within that business that are ultimately responsible for driving our performance. And then to make it all fit together, the last one is around incentives, making sure that we have an incentive plan that's tied into the business performance. Now, we most commonly use an employee share plan to do that. You don't have to use an employee share plan, but I'll show you in a moment why it works particularly well. Ownership mindset cultures retain employees at a 200% better rate than non-engaged cultures. Now, that's about 2 key things. One, it's about knowledge and sharing information with the employees, information they often don't get to look at or understand. And 2, it's about getting them engaged. So it's not just about showing them information and then going on about business as normal. It's about asking for their involvement, their suggestions, their help. I've run many, tens, probably even hundreds of workshops around ownership mindset over the last 10 years. I've met probably 2 or 3 employees out of many hundreds who were not interested and keen, in fact, to be more engaged in the business they work for. My very strong view is there aren't any employees that go to work thinking, how can I do a really bad job today? Or how can I bugger something up? People don't think like that, in my experience. What they don't have, though, is often the information, the knowledge and the training to help them work out how to do a better job. The knowledge piece is really important, and I talked about, dashboards and KPIs, and we'll talk about those in a moment. But it's also just about making sure employees understand how the business works. Businesses make money based on a couple of very simple premises, and it's about understanding those and helping employees to understand those in the context of the business they work for, so that they can become more involved and engaged with the knowledge that they need. This model comes out of Mitsubishi Motors in Japan. It's called the Iceberg of Ignorance. And it talks about the fact that what your employees don't know can hurt you and your business. Employees aren't aware of what's going on, they're not aware of how the business makes money, then that will ultimately hurt you. They will make decisions in the lack of that knowledge or information that will be the wrong ones. Interestingly as well, this model on the right-hand side shows only 4% of problems are known to the senior management team in most businesses. But 100% of problems are known to frontline employees. In other words, the information's there. People know what's going on in your business. They know where the problems are. They know where you're wasting money. They know what processes are inefficient, but they're not often asked for that information. And so the further down we go into the depths of that iceberg, into the people that are actually at the front line with our customers, the better understanding we have about what's happening in our business and how we can improve it. In terms of knowledge and information, I think it's important to do three key things. We need to track performance and keep score, but we also need to monitor and manage that score or that performance to make sure we can do something about improving it. Most businesses work off financial statements, and that's perfectly fine. I'm an accountant by background. They're important, but they're not important in terms of running the business day to day. What's important are some of the key numbers in those statements that are really critical to driving performance in your business. Most financial statements, even if you've got the best accountant in the world and they give you your financial statements on the 3rd of July for June 2020, it's still too late. You can't go back and change anything in June when you're looking at your statements in July. So you need something that's current, that's not complicated, that's connected to the actual running of the business, and that's easy for you to find and measure and report to employees so that something can be done around improvement when and if it's required. Now, the key thing with the systems we're talking about is not just focusing on these lagging financial measures, but identifying the most critical activity-based measurements, which we call and everybody calls key performance indicators or KPIs, and using those KPIs to improve results. Now, to do that, you need to look at them regularly. You need to look at them quite often. I know if you're working in a retail store, people will run the cash register off at the end of the night, or there'll be an IT system or even an app that measures sales for that day in that department, in that location, whatever it might be, so that people can see what's going on in the business day to day. In professional services firms and with other businesses, sometimes that's not as easy to do. So you need to design a way to measure what it is that's actually driving the performance of the business. Now, the key thing here is to understand the difference between leading and lagging indicators. Financial statements are lagging indicators. They report on something that's already happened and they can't change. It's just reporting fact or history, and that's fine, and we need them, as I said before. What we want to find are indicators within our business that will tell us what's going to happen next month. So right now at the end of June, I want to find an indicator that will tell me what my business is going to look like in July and August. Now, where do I find that? Well, we have to think about the business and what would be a predictor of behaviour, of performance, of sales, of profitability in July and August, in the next couple of months coming down the track. So a couple of key things that clients look at. If we want to find out what our sales book's going to look like in July, we might well look at how many quotes we did in June or even May, or how many proposals we've got out in the marketplace. One of my clients, who's a buyer's agent, regularly looks at his Google Analytics account to see how many inquiries have been on his website, how many people have clicked on his blog or his webinar. Those are predictors of future behaviour, so they're leading indicators. They lead into the future with some information that we can use to measure performance. Now, the important thing is we've got to do this regularly so we can do something about it. It's no good looking at my July projections and realising I'm going to be $500,000 under budget and not doing anything about it. We have to actually pause halfway through the month or even every week and have a look at our performance against the budget and just see if we're actually going to achieve the target that we've set. Now, here's an example where we've got two key things happening. Firstly, you'll see there's a combination of financial and non-financial measurements. All businesses need a mixture of both. Secondly, we've got names next to each of the measurements, someone who's actually responsible for that area and looking after it. And third, we've got three columns, not just budget and actual, which is what a lot of people use in reporting, and that's okay. We've got a forecast column, and the forecast column is about measuring that through the period. So if I'm looking at June, I've looked at this on the 10th and the 20th, and then at the end of the month, I can actually do something about it. If the target is not likely to be met, or if I'm falling behind, or there's a problem, the earlier in June I identify it, the better chance I have of doing something about it before we get to the end of the month. But I can't do that if I wait till the 3rd of July and look at it, because it's already too late. So in every business, we need to identify what are the key things we need to measure to drive performance. We need to make sure they're leading indicators, not lagging indicators, and make sure we can do something about improving them on the way through. Then we need to design an incentive plan that motivates employees to achieve those goals and rewards them when they do. And in fact, more often than not, we are actually called in to either wind up or get rid of an old incentive plan that doesn't work, or at least redesign it, fix it up, make sure that it actually does what it's supposed to do. Most of them don't work particularly well. And there's a couple of key reasons why. The most common thing we see is entirely black box incentive planning, where no one has a clue how anything's calculated. No employee can describe to you the bonus system or the incentive plan. And in fact, the owner probably can't even describe it to you, because what they really do is sit down at the end of the year, see how much cash is there, work out who they want to give it to. It's all discretionary. They make a list of employees, write numbers next to it till it adds up to the right number, and that's what we pay. Absolutely no link to any performance or work that's been achieved, no perceived value either, because no one really knows what they're getting or why they're getting it at the end of the day. The other one that's really important is the issue around uncommunicated goals, or even worse, changes during the time frame. If we change the bonus system or the incentive plan halfway through, that's not going to work either. That's just like moving the goal posts halfway through a game. It's never going to work. On the right-hand side, though, there are a couple of key things we can learn about designing incentive plans that actually works. The first one is they must be self-funding. There's no point having an incentive plan that costs the business money and doesn't deliver any improvements in performance. That's just not worth doing. Obviously, we need to have shared targets and understandable goals. Employees need to know what they're aiming for. They also need to have some skills, education, and information to allow them to know how they're going against those goals and targets. Are they actually achieving them, and what do they need to change if they're not? The goal should be a stretch but attainable, not ridiculously hard, but also not ridiculously easy, something that they can achieve, but that needs a bit of work behind it. And the last one I think is really, really important. It must clearly align employee behaviour to a business objective. Otherwise, what are we doing it for? We need to make sure that the business change that we're looking for, and I'll give you some examples of changes that clients have used. I've had incentive plans that have been designed to reduce sick days and leave, unpaid leave in one business. I've had incentive plans that have been designed to increase or improve referrals between different departments in the business. I've also had incentive plans that were designed to reduce safety incidents on a work site. And so it really can be a matter of working out what your key business objectives are. Maybe it's to reduce your debtors days to improve cash flow. Maybe it's to grow your sales by more than 20%. Maybe it's to achieve a net promoter score of above 80% for your customer service team. Any of those can suit and can match with an incentive plan. Key thing is the employee behaviour and the business objective must match. Otherwise, we're rewarding behaviour that doesn't drive the business outcome we're looking for, which is pretty pointless. Now let's talk about employee share plans and just make sure we've got a bit of an understanding of how they work. I'm going to run through some different designs of employee share plans and some of the rules around how and why they work, the taxation and accounting treatment, etc., just to give you a bit of an overview of how they work. And we're going to finish up with some case studies on employee share ownership plans that we've used with clients historically, and just show you what they've done and how they've actually worked. Again, same theme. We're allowing employees to own equity in the company they work for, with the express intention that they will think and act like business owners. If we can get that happening, you will definitely get fairly substantial, in my experience, improvements in performance within the business. Why are people implementing employee share ownership plans? There's a couple of key reasons. Obviously, as a succession strategy, I have several clients that are selling their business to an employee share plan. I've got others that are using the employee share plan to simply retain key people. And of course, we also normally get productivity improvements. We normally retain and engage people, our employees, much better. And lastly, some owners are using them to extract cash prior to their actual retirement. There are fairly tax effective ways to use an employee share plan to extract cash for the owner by selling down shares gradually as the employee share plan becomes a shareholder within the business. The research is quite overwhelming. The academic research is fairly positive in nearly every single case. These businesses with employee ownership tend to grow faster. They definitely ride out hard times better, and we're seeing that at the moment, and live longer. They can generally attract better paying customers. There's quite a big body of research out of the United States by a group called Certified Employee Owned, Certified EO, that says that customers are more likely to buy from and are happy to pay more to an employee owned business. They also generally have better places, better workplace cultures, and financially their workers, their employees, tend to be better off over time as well. So quite a few fairly serious benefits to talk about. In terms of staff retention, not quite double, but nearly, 9.69 years versus 5.5. It's quite a dramatic difference. That's computer share research here in Australia a couple of years ago. This is the one that I like. Performance improvement somewhere between 7 and 23%, where companies get two things right. One is the employee ownership or an employee share plan, and the second is high participation, high performance, engagement. That's the ownership mindset style approach. But 7 to 23% improvements are obviously quite substantial. That's a fairly serious growth number or performance improvement number that most business owners would be pretty happy with in the current environment. Let's talk about some of the different plans and how they might actually work. Firstly, startup plans. For the business itself, there are 4 key conditions. You have to be an Australian resident taxpayer. The company or business needs to be less than 10 years old. You have to have aggregated turnover less than 50 million, and you can't be listed on a public exchange. Once you meet those rules or those criteria, then you can move down into the employee eligibility, and the rules are pretty simple. Firstly, you have to have less than 10% of shares per person, each individual. They must be an employee. The shares must be sold to them at less than a 15% discount. They must hold them for more than 3 years, and they must be available to at least 75% of employees with more than 3 years service. In other words, a broad-based employee share plan. Now, they're the rules for startup plans. And if you qualify for all of those, then it would be fairly advantageous to use them. The tax concessions that go with startup plans are very, very generous. So there's no upfront tax, no tax at vesting or exercise. Generally, participants only taxed on disposal, and they get the 50% CGT discount. So quite advantageous to use these startup plans. And we've got quite a few clients that are using them to reward or remunerate key people. You know, where you might have an IT business startup where you need a key programmer. That person typically earns 150 grand a year. You probably can't pay them 150 grand a year, so you might pay them 100, and the balance is given to them in this startup employee share scheme to make up the difference, where suddenly they've got the equity growth in the business because they're invested in it and working with you on developing it. Now, if you don't qualify for the startup rules, there are another group of rules called deferred tax plans, Division 83A, which talks about just deferring the taxation that would normally apply to an employee share plan. And there's 2 things you can have. Firstly, it's either got to have a real risk of forfeiture. So in other words, you could lose, there is a real risk you could lose the shares or the equity, or The scheme's a qualifying salary sacrifice arrangement, which is not very common or popular because the salary sacrifice amount is actually quite small. It's only $5,000 per year at the moment per employee. So for most businesses, that really doesn't work. It's not enough. If you meet one of those two criteria, then you can defer the tax for up to 15 years, which is quite a substantial deferral period. If you think about 15 years, you get taxed 15 years later. For the shares that you receive in 2020, you can defer the tax until 2035, which is a pretty substantial benefit in anyone's book, I'd imagine. Once the taxing point arises, either 15 years is up or there's no longer any risk that you can lose them. So if it says after 5 years you can keep the shares no matter what, then that real risk of forfeiture has gone. Now, in some of our clients, those plans don't work or don't deliver or don't meet what the client's actually trying to achieve. And so we've actually designed a specific model called a peak performance trust, which is an employer-created employee share plan trust. And I'll show you the technical details of the actual structure and how it works in a moment, where it's set up for the benefit of employees. The only thing it's allowed to do is acquire equity in the business that the employees work for. And it normally is based on achieving predetermined performance outcomes, often profitability, but sometimes other things, as I said before. It may well be different aspects of performance within the business that we're trying to improve. In terms of the structure, this is an example company, Smith Trading. It's owned by John and Jane, who are the founders, mum and dad, let's call it. The business has been around for several years and they've got some key employees down the bottom there that they want to invite to join them. We set up a completely new and separate vehicle, so we don't touch that existing equity structure. We bring in a new shareholder, and the new shareholder in this example is the Smith Trading Peak Performance Trust, which is our employee share plan. The employees get invited to join the employee share plan, and the share plan, as I said before, is only able to buy shares in Smith Trading over a period of time. We have a trustee, so like a family trust or even a self-managed super fund, our employee share plan trust has a trustee. The trustee's job is to make sure the share plan is run according to the rules. And so a very limited role, but a very important role to make sure things work. The employees are then invited to become unit holders in our unit trust. And if they accept that invitation, we then set up a model where, based on a profit share plan, and I'll tell you why that's important in a moment, but based on a profit share plan, the company agrees that once we meet certain performance criteria, they will pay an amount of money across to the Peak Performance Trust. That money, as I said before, can only be used to buy equity, and the only place that we can buy equity from in this particular model is from John and Jane. And so the money moves from the company to the employee share plan, and then from the employee share plan up to John and Jane to buy the shares. Now, I mentioned the profit share plan before. That's quite an important aspect, because often what you'll find, if you've got key employees in your business, you may well have some that are fantastic employees, quite valuable to the business, but they don't have the financial capacity to buy shares. And so we don't want to preclude them from being involved in the plan just because of that. What we want to do is find a way that by improving the performance of the business and increasing the profit, we can actually fund them into acquiring those shares without necessarily having to draw down on their own cash reserves or borrow money, etc. They can do that. The structure allows them to do that, but we don't want to preclude people because they can't do that. You know, they may be younger, just married, bought a home, got a mortgage, kids in school, all that sort of stuff, where the financial capacity is not there necessarily. We don't want those people to be excluded from the plan. Now, how does it work? What we typically do is set up a profit benchmark. So we decide what performance we're looking to achieve. And in this example, it's $500,000. So below $500,000, nothing's going to happen in our employee share plan. If the company next year, if Smith Trading makes $450,000, nothing's going to happen. And employees know and understand this throughout the year. We've got a shared target. We know what we're trying to do, and that is get the profit above $500,000. Once we get the profit above $500,000, then we're sharing 20% of all monies above that $500,000 goes into the employee share plan. So this is a profit share plan with a benchmark. We start with the benchmark. Once we get over that, 20 cents in every dollar, 20% goes into the employee share plan. And you might remember from before, the only thing that the employee share plan can do or is allowed to do with those funds is to buy shares in Smith Trading. And so that model continues to work. In our example, we get to the end of the year at the top right-hand side there in step 1, we've achieved a profit of 600,000. So we've met our benchmark hurdle. We therefore have an excess of 100,000. 20% of that is $20,000, and that $20,000 is paid down the bottom left in step 2. A cheque's paid from Smith Trading into the Smith Trading Peak Performance Trust. That amount that's paid across from Smith Trading into the employee share plan is tax deductible to Smith Trading, but it's not taxed in the hands of the trustee or the employee share plan, and it's deferred tax in the hands of the employee. So there's some tax benefit there. The next step then, the trustee uses the funds to buy 2% of shares in Smith Trading. So we've done a valuation, we've worked out what Smith Trading is worth. $20,000 in this example gives you 2% of Smith Trading, and that 2% of shares that were owned by John and Jane. John and Jane receive a cheque for $20,000, and the employee share plan now owns 2%. John and Jane now own 98%. And that model simply works year on year, depending on what our profit target and our actual profit are. An amount of money will be paid across every year that we meet the benchmark, until one of two things happens. Either we buy 100% of the company over a period of time, which several of my clients have a plan that is working towards that, or we have a cap, and lots of my plans have caps where the employee share plan will only ever own 20% of the equity, and the family, John and Jane's family, will continue to own the other 80% theoretically forever, and retain it in the family. That model works pretty well. A couple of key things we need to think about around how we get in and out and what the rules are. Firstly, we've got to have some criteria that must be met before staff can join the plan. That might be 2 years service, or it might be a certain level of seniority, or it might be, I've got one client who put in place that you had to have 2 years in a row where your annual performance review scored more than 80%. If you didn't get that, you weren't invited into the plan. Secondly, we've got a performance benchmark. The example I showed you only had one, and that was profitability. Often we have profitability as a core benchmark, but we might also have improvements in customer service scores, net promoter score, safety days, sick leave, quality control, returned items, customer complaints. I've had all those different things combined into employee share plans. Then we get to the other end of the plan. I think it's important to understand what happens at the other end when people leave. By definition, an employee share plan, you have to be an employee to be part of that employee share plan. So if you leave the business, you're automatically disqualified, and that's called a disqualifying event. There are also rules around good leaver, bad leaver. So if you are a bad leaver, fraudulent activity, bringing the company into disrepute, and a whole stack of other things, then you get nothing, simply. If you're a good leaver, then your value that you receive when you leave is simply decreased, it's discounted by the period in which you leave. So in other words, to make that much more simple, the employee value increases the longer you stay. So if you leave after year 1, you might only get 20% of the value. Year 2, 40, year 3, 60, year 4, 80, etc., until eventually you get 100% of the value of those shares. And that disqualifying discount stays part of the plan. That's a very strong part of the retention mechanism. There is some of those shareholdings at risk if you leave the business, and that's on purpose. It's designed to be a retention strategy. At the end of the year, there's a couple of key things that you need to do. Firstly, you need a valuation, and then the administration. Now, we do the administration for employee share plans for all of our clients, and we manage redemption of units and people changing address and moving around. We use an online admin portal where people can log in and get an update based on the performance of their shares. They can get dividend statements and just see how things are moving, etc., and what's happening. Let's have a look at some case studies, and then I'm very happy to pause and answer any questions that people might have. These are real clients of ours that have used our employee share plans or ownership mindset, and I'll just scroll through them and talk about some of the consistent benefits. This company was largely focused on reducing sick days. They had a lot of overtime, which meant that their employees were earning a lot of money and were quite happy to take a sick day, even if it was unpaid sick leave, because they'd already earned quite a lot in overtime. The ownership mindset program, where we educated employees around the cost of that and what impact it was having on customers and the business, really did change the way that that worked. LJ Hooker Commercial Central Coast. These guys won the Employee Share Plan of the Year award back in 2011, at which point the plan had been around for about 5 years. Certainly talking about, Ty Blanche is one of the directors there, talking about the improvement in performance, but also talking in this slide about the engagement level and the number of increased referrals between the various businesses within LJ Hooker unit. And that I think is a quite interesting one, because that obviously directly relates to profitability, and it wasn't really a benefit or a gain that was seen before. Now, as Ty says here, put this down to seeing value in contributing to the company's bottom line, because they share in it. And so there's a real tangible connection between employee behaviour here and the outcome. CMAC. CMAC's an interesting one. They won the Employee Share Plan of the Year for succession planning back in 2012 using our Employee Share Plan, the Peak Performance Trust. It's in a period of family succession. It's actually subsequently converted to a cooperative and then subsequently been sold. So it's been through a number of different transitions and succession plans as part of that, but it started with an Employee Share Plan back in 2012. Untitled is a large client of ours. We've been working with them for several years now. We introduced ownership mindset well before we introduced the Employee Share Plan. It started in 2017. Obviously, 3 years later, there's now 39 employees, 20% of equity, etc. There's been significant improvement in performance and engagement and so on. And I'm hoping we can get this video to play.
The success of Untitled is really about commitment and dedication of our great team and our talented people, and we're nothing without our people.
You often hear a lot about employee share plans. What's unique about our share plan is the percentages of staff ownership that we are aiming for.
By and large, the philosophy behind it is about engendering ownership thinking and ensuring that that thinking affects your day-to-day actions in a positive manner. You're not just thinking about what you're doing or what your team's achieving, but you're understanding that the impact of what you do affects the whole business, and that your colleagues are working together in that same fashion.
We were a bit naive in terms of what the opportunity was out there in terms of employee share plans, and we were referred to Craig from another business advisor at Succession Plus to give us some advice about what the opportunity might be.
My initial response was good. I thought it was a great idea for us to move towards. I had reservations about certain aspects, but any concerns were allayed pretty quickly. There's always been a willingness to answer questions and to give staff at all levels the opportunity to probe different aspects of it to increase their understanding.
Similar to our business, the best part of dealing with Succession Plus is their people.
I personally get on well with Craig. I just found that just tells it how it is. And he's very approachable. He was really good at targeting and tailoring what we needed based on who the person was.
It's been a learning process on all counts along the way, trialling things that we thought would initially work, and then when we got either legal advice would change things or tweak things here and there. When we did find Succession Plus, Craig obviously came on board, and from that point of view that was a good mix for us, because that was the sort of plan that we were looking for. So there's been a long process about putting the governance in place that would make the employee share plan work. We chose to go down the road of getting an ATO ruling so that there was no risk on the employees' side at all.
They were quite deliberate in making sure that as a business we were ready, because rushing these things is where I have seen and heard of the culture challenges where you create quite competitive teams that work against one another in a way, whereas the speed that was integrated and developed for us meant that we were ready.
In my view, it's not enough just to put an employee share plan in place. We could have just done all the legal documents, signed them all off, and there's the employee share plan. Let's leave it at that. Hopefully that'll all magically work. That's not actually the case. It's part of the recipe.
And I was really pleased and proud that the loyal and committed team stayed with us on that journey. They trusted that we were going to get there, and we certainly did in the end. And then we were really pleased last year to roll out our employee share plan and to now have more than 30 people as current unit holders in the employee share plan trust.
I think fundamentally for me it makes me feel like I'm effectively an owner of the organisation, and the actions I undertake day to day have broader ramifications for the company's success.
As we all take more ownership, that'll improve the sustainability of our business, and our clients can know that we'll be here in the long term.
We've already got employees thinking like business owners. A lot of you have already come up with ideas or feedback or input that is a little bit above and beyond what you'd normally come up with as an employee, because you're thinking about it from a business owner's point of view.
There's no doubt that having the employee share plan in place is important for us to be able to compete with our range of competitors for great talent.
We find empirically through our survey results that the ESP component of Unwell is one of the reasons why staff are being attracted to our business.
Generally, it's been very positive, and particularly, when dividends start to get paid out, which has already happened. We went through our first payment. That was well received, as you can imagine.
The basis of ownership thinking and ownership mindset is that each individual takes on a personal interest and a role in the success of the business.
Just a couple of resources to finish off for further information. I'm very happy to answer questions as well. We've published a book called Build It, which is all about employee share ownership plans. It's available for free on our website. Just go on the website and you can download a copy of an ebook version. You can also buy it direct if you want a hard copy. Just flick me an email after this. I'm very happy to send you one in the mail. If you prefer to actually have a physical book in your hand, I'm very happy to do that as well. Any questions? For those of you that haven't used Teams before or perhaps aren't used to it, it's very easy to just type a question into the box, the chat box up on the right hand side, and you should then be able to answer any queries that you've got. Not seeing any popping up there, but oh yeah, okay. Yeah, okay, so the first question is around timing and how long does it typically take to implement an employee share ownership plan. Generally, our process is about 3 months. There's a fair bit of work involved, including evaluation of the business that needs to be done up front. And so the 3-month process is typically, the first month is valuation and financial design of the plan, working out what parameters we need to use to make the plan work most effectively and what outcomes we're looking to achieve with it. Month 2 is typically largely around ownership mindset, education, running workshops with employees and getting them up to speed, whilst in the background we're designing the documentation. And month 3 then is actually the implementation, which is largely legal and technical, the trust deed, the employee manual, which goes out to employees, making sure everyone's got the documentation they need, etc. So 3 months. The next one is related to cost. Yep, so the process, as I said, takes 3 months. It's typically about a $20,000 project to put in place an employee share plan, including the legal and disbursements and so on, and the training that needs to be done with employees to make sure you get the best outcome. You can do an employee share plan without that training, but in our experience, it certainly works far better if you have the training as part of the implementation as well. Okay, there's another question. Yep, okay. Yeah, okay, so the question is around what can go wrong or what doesn't work well. I think probably both actually. So what can go wrong or what doesn't work well? If you rush the implementation and skip over the steps of education, you would have heard in that Unwell video people talking about the time that we took to gradually educate and inform employees about the plan, how it worked, what ownership mindset was, what they were looking for and what they were expected to do. And then also making sure that you also have to make sure you've got the right people in the plan. So I generally tell people, start slowly, start with a small number of people and gradually add to that over a period of time, so that you make sure you're gradually growing the plan with the right people at the right stages to make sure that it works most effectively. If there are any other questions, I'm happy to answer them as we go. Please just type them into the chat box if you do have questions, and I'm certainly happy to answer them as we go. If there are no more questions, my contact details, just make sure I put them on the screen for you. If you do have questions that you would like to ask separately or after this, I'm very happy to answer them separately. And most easiest way to do that is just to email me. It's just cwest@successionplus.com.au. There are plenty of resources on our website, including recordings of webinars like this one. There are some podcast interviews, including an interview with Barbara Crossley, who's the CEO up at Umwell. The Umwell videos on the website, etc. So if you are looking for more information, I'd encourage you to go and jump on one of those resources and see what you can find. Hopefully there'll be enough information on there to help you. I look forward to any other questions, either now or later on. If you do have them, happy to answer them. Otherwise, thank you very much for joining me. I hope that's been helpful, and I look forward to helping you. If you do decide to go down this road, I'm very happy to work with you and see what we can do to implement an employee share plan. Thanks for your time today, and a recording will be available to attendees after this as well. We'll be in contact with you with the details of how to get access to that. So thank you for joining us. Hope that's been helpful. Have a great day.